1 minute smarter, every market clearer. Welcome to my channel, I'm Claire. Hello everyone, and welcome to today's deep dive. What if I told you that over the next 2 years, we might witness the S&P 500 surge to a historic high of 8,500 points? It would be an unprecedented wealth miracle. But at the same time, it could serve as the overture to an economic winter far more painful and prolonged than what we saw in 2022. How would you feel about that? Is this a signal to go all in and enjoy the final frenzy, or a warning to liquidate and find a safe haven? Today, we aren't going to talk about shallow news noise. Instead, we're going to look past the surface and use underlying data to map out a survival guide for investors. Let's take a close look at the most pulse-pounding part of the current market. The S&P 500 has sprinted from its 2022 low of 3,500 points to its current level of 6,800, a massive 90% gain. Conventionally, it seems the market has already overextended its future gains, but in the eyes of Wall Street bulls, the party is just reaching its climax. I've found a logic hidden in the data that is truly fascinating. For the next 2 years, the market will enter a Euphoria phase driven by the twin engines of AI capital expenditure and declining interest rates. This isn't just hype. Tech giants are pouring money into hardware, computing power, and energy infrastructure at any cost, just to secure their ticket to the AI era. This wave of capital, on the scale of an industrial revolution, will translate directly into revenue for companies across the supply chain, supporting valuations that otherwise look expensive. Meanwhile, the Federal Reserve's general direction for monetary policy is set. When money becomes cheap, it floods into financial assets like a deluge, creating an illusion for investors that high valuations are the new normal. Interestingly, the data shows a stark divide in the market. While the S&P 500 has risen 13%, the Russell 2000, representing small-cap stocks, has only climbed 6%. This disconnect stems from the heavy reliance of small and mid-sized enterprises on debt financing. High interest rates have been suffocating them, but once the rate cut channels fully open, the financial pressure on these companies will vanish instantly, triggering a catch-up rally even more violent than that of large-cap stocks. Driven by this sentiment, seeing the S&P 500 rise another 25% to 30% to hit 8,500 is not a fairy tale. However, as an independent observer, I must remind you that the one immutable law of financial markets is the cycle. The market always cycles through 4 stages: hope, optimism, belief, and euphoria. We are currently on the edge of transitioning from belief to euphoria. In the coming year of 2026, making money will feel exceptionally easy, so easy it might make cautious people look foolish. But remember, euphoria is often the end of the cycle. The true hidden danger isn't in the stock market, but in the foundation of the real economy, the labor market. While stocks are rising, the latest employment reports are sounding a piercing alarm. The unemployment rate has climbed to 4.6%, showing a clear upward trend. As of November 2025, total corporate layoffs announced were nearing 1.2 million, a 54% surge compared to the same period last year. This wave of layoffs has spread from telecommunications and tech into foundational industries like food and services. I find this point particularly intriguing. The displacement effect of AI on employment has moved from prediction to reality. In November alone, over 6,000 jobs were cut due to AI, with more than 50,000 lost throughout the year. This indicates that while technological progress drives stock prices, it is simultaneously eroding the purchasing power of the average consumer. Speaking of purchasing power, we must dismantle the lie that wages are outperforming inflation. Official data shows CPI dropping to 3% while wages grew by 3.5%, prompting media outlets to cheer for an increase in real income. But I've found that CPI reports measure cost of living adjusted for substitution effects, which is not the same as actual currency devaluation. If you feel that things at the supermarket are still getting more expensive, trust your wallet, not the polished numbers. Even more concerning to me is the underlying money supply, or M2. To counter the economic slowdown, the Federal Reserve has quietly restarted the printing presses. M2 annualized growth has reached 5% and may soon approach 6%. Economic common sense tells us that a surge in money supply is a leading indicator of inflation. The current rate cuts are like pouring a bucket of gasoline onto an inflation fire that was just about to go out. This means by 2026, we might face an extremely difficult macro environment: stagflation. On one hand, inflation will resurge, causing corporate costs to skyrocket. On the other, unemployment will rise and consumer spending will weaken. Even Fed Chair Jerome Powell has admitted that official employment data may be significantly overstated, potentially overcounting by about 60,000 jobs per month. When official data is sugarcoating the truth, the actual state of the economy may be much worse than what we see. The Fed is now caught in a dilemma. Cut rates too slowly, and the labor market could collapse, causing a hard landing. Cut too fast, and the monster of inflation will break out of its cage. The lessons of the 1970s tell us that once inflation resurges, it's often more destructive than the first wave. So, as the market evolves in 2026, how do we know if we're at the edge of the cliff? Let's look closely at 5 red flag signals of a late-stage cycle that I've summarized. First, the flow of speculative capital. Money stops flowing into stable blue chips and instead floods into high-risk, non-profitable assets based purely on storytelling. Second, distorted return expectations. When people feel a 30% annual return is too low, greed has swallowed reason. Third, soaring leverage. Record levels of debt and margin mean the market is extremely fragile. Any minor disturbance could trigger a stampede. Fourth, extreme valuations. If the S&P 500 PE ratio touches 35, 37, or even 40, we are looking at a historic bubble. Fifth, a state of total euphoria. When the fear and greed index stays in extreme greed for a long time and the market ignores any bad news, that is the final frenzy. Faced with a future that offers both massive profit and hidden risks, my core strategy is: prepare, don't predict. Trying to perfectly time the top often leaves you burned on both ends. You need to build a rigorous survival system. I've summarized this into 6 investment rules, our amulet for navigating the cycle. Step 1. Establish your underlying investment logic. Many people lose money because of split logic, buying for long-term reasons, but holding with a short-term, get-rich-quick mentality. You must be clear. If the stock price drops 30%, are you excited to buy more or panicking to sell? Step 2. Reject complexity. During a mania, new concepts fly everywhere, but complexity is often a breeding ground for fraud. If a company's business model requires solving a high-level math problem to understand, or if the financial report reads like a riddle, throw it in the trash. Step 3. Look for the ceiling of returns. We want to find sectors deep within trillion-dollar markets that can grow even if the economy slows. We are looking for ships sailing with the wind. Step 4. A financial X-ray. Revenue growth is the face, but profit and cash flow are the soul. Be wary of companies that sustain growth through frantic acquisitions. Step 5. Find an insurmountable moat. I believe pricing power is the ultimate anti-inflation tool. If a company raises prices and customers complain but still buy, that's a moat. If they raise prices slightly and customers vanish, they won't survive stagflation. Step 6. Strict position management. Absolutely avoid leverage and eliminate your margin debt. Maintain a cash position, stick to dollar-cost averaging, and reevaluate your reasons for buying every quarter based on financial reports. Standing at this point in time, the script we've mapped out sounds contradictory. The celebration of 8,500 points coexisting with the shadows of high inflation and high unemployment. But this is the brutal truth of the modern financial system, the great decoupling of asset prices from the real economy. Stock market prosperity no longer simply reflects economic health. It reflects currency devaluation and the scramble of capital for a safe harbor. The next 2 years will be the ultimate stress test for every investor's cognitive framework. You will see people get rich overnight by betting on meme stocks, and you will see value investors temporarily underperform. But the essence of wealth redistribution is the transfer of assets from emotional, highly leveraged speculators to those who are calm, objective, and grounded in common sense. Interestingly, while financial history doesn't repeat linearly, human greed and fear always rhyme. We don't need to predict the exact second the storm arrives. All we need to do is fix the roof, stock up on food, and wait for the cycle to turn. This survival rule is like being in a forest before a fire. You don't just look for water, you make sure you're standing under the tree with the deepest roots and the thickest bark. While the flames will consume the brush, the seeds that endure the heat will be the ones to welcome the next spring in the ashes. Don't forget to like and subscribe to my channel. I'd love to hear your thoughts in the comments, so let's keep the conversation going. See you in the next episode.